Welcome to Stock Informer for You. The noise in the market is loud, but we prefer to let the data do the talking. Imagine buying a brand new car, driving it off the lot, and the very first time it rains, the roof caves in. You'd be furious, right? You'd say, why didn't anyone test this for bad weather? Yet, millions of investors do the exact same thing with their money every single day. They buy a stock because the company looks great right now during economic sunshine. But they have absolutely no idea how that company will perform when a financial storm hits. In this video, we are breaking down the absolute essential step you must take before risking a single dollar on a stock: the stress test. By the end of this 5-minute video, you'll know exactly how to pressure test any company to ensure your portfolio survives the next market crash. What exactly is a stock stress test? So, what is a stock stress test? In the banking world, regulators force major banks to undergo stress tests to see if they can survive hypothetical disasters, like a massive real estate collapse or a sudden spike in unemployment. As a retail investor, you need to do the exact same thing for individual stocks. A stress test is a simulation where you ask, how does this company's business model hold up under worst-case scenarios? We aren't asking if the company will grow by 10% next year. We are asking if the economy grinds to a halt, if inflation doubles, or if a major competitor cuts prices by half. Does this company stay afloat, or does it go bankrupt? The 3 core pillars of a stock stress test. When you stress test a stock, you want to focus on 3 critical pillars. Pillar number 1, the debt load. Look at the company's balance sheet. If a recession hits, revenue drops, but debt payments stay exactly the same. Check the debt-to-equity ratio and the interest coverage ratio. If a company is buried in debt and interest rates rise, they are in immediate danger. Pillar number 2, fixed versus variable costs. Companies with high fixed costs, like airlines or manufacturing plants, have to pay for factories and equipment, whether they sell 1 item or 1 million items. When demand drops, they bleed cash fast. On the flip side, software companies often have variable costs that they can scale back quickly during a downturn. Pillar number 3, pricing power. If inflation causes a company's raw material costs to surge, can they pass those costs onto their customers without losing business? A company like Apple or Coca-Cola has immense pricing power. A generic commodity business does not. Why this saves you from massive losses? Why is this so important? Because the stock market is cyclical. Crashes and corrections aren't a matter of if, they are a matter of when. When market euphoria is high, every company looks like a winner. Cheap capital hides bad management and fragile business models. But when the tide goes out, you find out who has been swimming naked. By stress testing before you buy, you weed out the fragile companies. More importantly, it gives you the emotional conviction to hold on to your winners. If you know your stock has passed a worst-case scenario test, you won't panic sell when the stock price drops during a market correction. In fact, you'll probably view it as a buying opportunity. Before you click buy on your next stock trade, don't just look at the revenue growth or the hype on social media. Take 15 minutes to run it through a stress test. Ask yourself, can it survive a 30% drop in sales? Can it handle its debt? If the answer is no, step away. Protecting your downside is how you build true long-term wealth. If you found this breakdown helpful, hit that like button, subscribe for more no-nonsense investing strategies, and drop a comment below. What's one stock you're going to stress test today? Thanks for watching, and I'll see you in the next video.